Welcome to the Deep Dive.
Hey there.
Today we're really getting into the weeds on Farmland Partners, FPI. Their Q3 2025 results just came out, along with the conference call.
Yeah, and it's a fascinating one if you follow REITs, especially in agriculture. It's almost a case study.
Oh, so?
Well, it's about how a company can kind of sidestep the whole top-line growth narrative. Instead, they used, let's call it financial discipline, to engineer a pretty big earnings beat.
Okay, financial discipline over growth. Got it.
That's really the story the market picked up on. FPI is clearly making a big strategic pivot, In this high-rate environment, they're simplifying, de-risking the balance sheet, shrinking things down.
And the market liked it.
Seemed to. A positive reaction, maybe a bit measured, but definitely positive. They delivered what mattered on the bottom line, even if it meant sacrificing some growth metrics, stability over expansion, basically.
Okay, let's hit those headline numbers then, because they really stand out. Q3 adjusted funds from operations AFFO per share was 0.07 cents.
Right, and you have to compare that to the consensus estimate.
Which was just $0.01 per share. So yeah, $0.07 versus 0.01 cents. That's not just a beat, that's phenomenal.
Exactly. And AFFO, that's the number REIT investors really focus on, right? It's that cash flow figure after adjusting for stuff like depreciation. That was the win.
But like you said, it wasn't a growth story. What about the other numbers?
Well, that's where you see the other side. GAAP EPS was basically flat, $0.00 roughly. Net income was only about $500,000.
$500,000, okay. Not exactly setting the world on fire.
And here's the kicker. Total operating revenues actually fell, down 15.5% compared to last year, came in at $11.251 million.
15.5% decline. Wow. Okay. So let's break that revenue down.
Sure. It was about $6 million from rent, roughly $2.8 million from crop sales, and the rest, maybe $2.5 million from other sources.
So the rental income itself wasn't collapsing, but overall revenue definitely took a hit.
Precisely. It immediately tells you the story wasn't about renting more acres or getting way higher rents. The success, that $0.07 AFFO, was all engineered below that revenue line.
Financial engineering and cost discipline, like you said.
Absolutely. Manufactured success, in a way.
So let's talk about that discipline. AFFO itself jumped 106% year over year. It's huge. Reached $2.887 million. How did they manage that kind of jump with revenue falling? What was the magic?
No magic, really. Just aggressive cost management. The entire increase came from two main things: significantly lower interest expense and just cutting operating costs wherever they could.
And management really sharpened their pencils then.
You took a scalpel to it, yeah.
But okay, let's look at the operational health metrics. Because if you look at net operating income, NOI.
Right, the property level profitability.
That actually fell 18% year over year down to $8.0 million. And adjusted EBITDA, another key earnings metric, that fell even harder, down 25% to $5.74 million.
And that contrast is the story. The actual farm portfolio, viewed on its own, performed worse.
So weaker results from the farms themselves.
Yes. But the market seemed to forgive that, or at least look past it. They rewarded management for being so effective at cutting corporate costs and managing the debt below that NOI line.
The financial management overshadowed the operational softness.
Completely. Their discipline was that effective.
And it wasn't just cutting expenses day to day, right? They were making bigger balance sheet moves.
Oh, definitely. They paid back $23 million on their credit line. That's serious deleveraging.
Significant. And they bought back stock too.
Yep. Repurchased 1.25 million shares. Average price was $10.84. Shows they think the stock's cheap compared to the underlying asset value, the NAV.
All part of this simplification pivot you mentioned.
Exactly. It's about becoming a pure play, simple, high-quality farmland owner. And two big moves highlight this. First, selling off the Murray Wise Associates subsidiary MWA.
Right, the brokerage and third-party management arm, not core farmland ownership.
Correct. They got a definitive agreement to sell it for $5.3 million, expected to close this quarter, Q4. Gets rid of a lumpy, non-core revenue stream.
Was $5.3 million a good price? Or were they just keen to simplify?
Hard to say for sure, but management sounded okay with it. They actually said the revenue impact of removing MWA would be, relatively speaking, negligible in 2026.
Negligible impact. Okay, So maybe it wasn't a huge profit driver anyway, more about focus and cleaning up the structure.
Seems like it. An immediate cash infusion and strategic simplification.
But the really big balance sheet move, the one that caught my eye, was a preferred share deal.
Ah, yes. The property for preferred exchange. That's where things get really interesting and maybe a bit bold.
Tell us about it.
They agreed to swap 23 properties in exchange for canceling $31 million worth of their Series A preferred units. That's also supposed to close soon, around December 10th.
Okay, so $31 million in preferreds off the books. How much does that leave?
It takes their total preferred exposure down significantly, from about $99 million to $68 million. A big chunk.
Now, hold on. Here's the question that pops up immediately. Preferred stock. Isn't that usually cheaper capital than, say, bank debt? I think those Series A units paid around 3%.
That's right, around 3%.
Okay. And management themselves said their credit lines are running in the mid-5s right now. So why sell assets to pay off 3% financing only to potentially rely more on 5.5% debt? Seems counterintuitive, no.
It does seem that way on the surface, and that's the key risk-reward you have to weigh. But there are a couple angles here.
Okay.
First, the immediate cash flow impact. They actually got an agreement not to pay dividends on those specific preferred units being extinguished, starting way back on August 1st.
Oh, interesting. So they saved on those dividends for Q3 and Q4 even before the deal closes.
Exactly. It's a small immediate boost to cash flow for Q4. But the bigger reason is strategic.
De-risking.
De-risking the capital structure. Preferred equity has fixed claims. Reducing those mandatory payouts makes the balance sheet simpler, more resilient, especially when rates are volatile.
So it signals to lenders they're serious about lower leverage, even if the immediate cost of debt is higher than the preferred dividend was.
Precisely. They're choosing lower overall financial risk over optimizing the cost of each individual piece of capital right now. Long-term structure over short-term interest savings.
Makes sense. And management used this deal to make another point too, didn't they? About the assets themselves.
They did. They made sure to highlight that the 23 properties they're selling were valued 56% higher than what FPI originally paid for them about 10 years ago.
Reinforcing that core farmland appreciation thesis. Even if rents fluctuate, the land itself is gaining value.
That's the message. Strong underlying asset appreciation.
All right, moving to the outlook. All these moves seem to have boosted management's confidence. They raised guidance.
Yeah, they bumped up the full year 2025 AFFO guidance, now expecting 32 cents to 36 cents per share.
Which clearly signals they think these cost controls and the strategic sales will more than offset that revenue softness we saw.
Seems to be the bet. And they put their money where their mouth is by returning capital.
The special dividend.
Exactly. Declared an expected special dividend for the full year 2025 of $18 to $D.22 per share. That'll be paid out in January 2026.
On top of the regular quarterly $0.06 dividend.
Correct. It's a clear signal to shareholders. Cash generated from these asset sales and cleanups is coming back to you.
And they have the means to do it. Liquidity looks okay.
Looks strong. They ended the quarter with $172.5 million in available liquidity. That includes their credit lines being fully undrawn, about $159 million ready to go.
That liquidity is crucial, especially with that MetLife term loan coming due. When is that?
March 2026. It's a significant maturity. Management sounded pretty calm about it on the call, though.
What's the plan?
They expect to renew it, probably with MetLife again or their other existing lenders. They did note the current pricing is 5.55%, but they think the spread the extra bit over the benchmark rate should stay consistent when they renew.
Okay. One other interesting point was their loan program. As they shrink the portfolio, they're trying to use loans to cover overhead.
Yeah, exactly. They're intentionally expanding their high-yield loan program. As the overall asset base gets smaller, they need other income streams to cover corporate G&A and things like that.
Makes sense. Did they originate many new loans in Q3?
Actually, no. They clarified the uptick in interest income this quarter wasn't from new loans, but just from extending an existing one. But it shows they're actively using that program strategically.
Okay, let's shift to the macro picture. FPI depends on farmer health, right? What did management say about rents or trade?
Well, on rents, it sounds like things have flattened out. After several years of good increases, they're seeing flat renewals right now.
Flat. So what are they doing? Locking in long leases.
Just the opposite, actually. They're strategically opting for mostly one-year lease extensions.
Oh, interesting. Why?
They're basically betting that the market might be better next year. They don't want to lock in current flat rates for too long if they think they can get better pricing in 2026, maybe if commodity prices improve or the rate outlook clears up.
A bit of gamble, but calculated.
Seems so. They did mention the recent China trade deal for soybeans that happened just before the call. They think that could give farmers a short-term material bump in profitability.
But will that translate to higher rents long-term?
That's the million-dollar question. Management said it's unclear right now, but they also reminded everyone their leases are fixed cash rents, so FPI gets paid regardless of commodity swings, and farmers have crop insurance as a backstop. Provides some stability for FPI's income.
Got it. Last point before our next segment, buybacks. With cash from sales, why not buy back more stock right away, especially if they think it's cheap?
Good question. Management said buybacks are always on the table, especially with the stock below NAV, but they indicated activity will likely slow down right after the special dividend gets paid.
Why is that?
Their view seems to be that when they get big chunks of cash from asset sales late in the year, like now, the special dividend is the best way to return that capital directly. Once it's done in January, they might revisit more aggressive buybacks. Dividend first, then maybe buybacks.
Okay, clear philosophy there. All right, we've reached that special part of the show.
Ah, yes, the mandatory disclaimer section.
You got it. Let's be absolutely crystal clear. What follows is not financial advice.
Yeah.
Seriously, we are just brainstorming here, taking the details from the call and spinning out a, let's call it, outrageous but plausible trade idea based purely on these upcoming events.
Purely for discussion, completely hypothetical. But here's the pitch, riffing off what we just covered. We noted FPI's stock has actually done pretty well recently, right? About 10.9% total return over the last year, while the broader REIT sector struggled.
Yeah, the Vanguard REIT ETF, VNQ, was down almost 3% in that same period. Big difference.
Okay, so the trade idea is short-term, totally catalyst-driven, and hedged, the idea. Buy FPI shares before the ex-dividend date to capture that big special dividend, the $0.18 to 22.2 per share coming in January.
Okay, capture the dividend.
And simultaneously take a short position in a broad REIT index ETF like VNQ.
Short the sector. Long FPI specifically. Why the hedge?
The rationale is you want to isolate the FPI-specific event. You're trying to capture the cash distribution that's coming specifically from FPI, cleaning up its balance sheets, the MWA sale, the reduced preferreds. By shorting VNQ, you're trying to insulate yourself from the general market noise hitting REITs, mostly related to interest rates.
So you're betting on FPI's specific cash return catalyst while trying to neutralize the broader sector risk.
Exactly. Betting purely on FPI's strategic capital release, hedging away the macro rate stuff. Again, not advice, just an idea sparked by the call details.
Understood. So let's wrap up the FPI Q3 story. Strong AFFO beat, guidance raised.
Yep, but driven entirely by that strategic execution. Asset sales, cost cuts, fixing the balance sheet, not by underlying operational growth this quarter.
They're effectively shrinking to get stronger, financially speaking.
That's a good way to put it. And the next big thing for you, the listener, to watch is that property for preferred exchange closing around December 10th.
And the key question that raises for next year.
It's that trade-off we discussed. Will the savings from eliminating those cheap 3% preferred dividends be enough to fully offset the higher interest costs they'll likely face by using more of that mid-5% credit line debt?
That's the core financial puzzle for 2026.
Absolutely. You'll want to watch their leverage ratios and listen closely to their 2026 guidance when it comes out to see how that balance sheet shift really plays out on the bottom line.
It really is a fascinating test case. Can aggressive deleveraging and simplification win out, even if revenue isn't growing, especially in this environment? Something to definitely mull over.
Indeed.
That's all the time we have for this deep dive. Thanks for listening.